friends and Transamerica friends in California. This is Susan Weiland, your long-term care wholesaler here at Crump speaking. Welcome to our One America California exclusive call. So we are going to be talking about reimbursement versus indemnity. What's it all about? How do we speak to a client about it? What are the differences? This is an important topic that you want your clients to decide. We don't want to decide for the clients. We want to have all the information and help to educate on this topic. So next slide. On your slide right now, this is me and my information, and also the Crump Long-Term Care Solution Center team. The team phone number, respectively, WFG, Transamerica, you have a dial-in, exclusive dial-in phone number there. You have an email, ltcquotes2@crump.com. They can run your quotes for all the Crump products that are available to you: Mutual of Omaha, National Guardian Life, Securian, and One America. And then I'm available for point of sale work. And you also have a One America wholesaler, especially California, because you know I'm on the East Coast. But if it's a One America that you're selling, you do have One America local wholesalers. They can do trainings with your teams, lunch and learns with your clients. They can help you. So please, at the end of the presentation, there'll be a map that you can download of who your wholesaler is. And next slide. The slide's kind of older. The website has changed at Crump. It's now, if you direct your eyes over to the right-hand side of your screen where it says Tools, on the new website, it's just going to say Quick Links. But what I want to point out is the Get Contracted and the Start New app. You must do your contracting here on this site. So remember, that's where you'll answer the contracting questions, get contracted with like One America or Mutual of Omaha or whoever. You're getting contracted, you're going to upload your CE certificate that you need. And then if you're selling qualified money, you need to upload or make sure that you have done the annuity training for the qualified money. That's Asset Care 3 in California and Asset Care Annuity Funding in other states. There's extra training for those products in addition to the CEs. So also, let me point out to the right-hand side of your screen, and if you can just go back for just 1 second for me, Blake. Okay, so I want you to take note of my email address here. So to the right-hand side of your screen, you should see a red arrow. If you click the red arrow, a menu box comes up. You're going to see a section called Handouts. Click the drop down for Handouts, and you're going to see 5 PDFs. You click on the PDF, it'll open in a new window, and you can save the PDFs. We have the Crump e-app instructions, how asset base works, tax deductions, the territory map, the wholesaler map for One America, and then there's a reimbursement and indemnity basics document, really important. The reason I went back a slide, if you can't find these handouts, email me and tell me you need the handouts and I will send them to you. So right now, grab my email address. If you can't find the handouts, just tell me you need handouts and I'll send them to you. Okay, so you can go to your slide, Blake. So Blake is on here with us. He is an internal over at One America. He's very knowledgeable, and he does our presentations once a month. This month, today, is going to be on indemnity and reimbursement. So sit back, relax, enjoy. There is a replay. You can have a copy of the slides, and you will get the replay as well. Anyone who registered will be receiving the replay. So welcome, enjoy. Thank you so much for joining today. And Blake, thank you for doing this presentation. We appreciate the partnership with Crump and One America and WFG and supporting all of us. So welcome and thanks for doing this.
Well, thank you so much, Susan. Thank you for having me here. We appreciate the partnership that we have with Crump and WFG as well as Transamerica. So appreciate everyone joining us for the call and presentation today. As Susan mentioned, my name is Blake Hotelling. I'm an internal wholesaler here at One America. And today I just want to take a little bit of time to really explore the key similarities and differences between indemnity and reimbursement policies. So during this presentation, what we'll do is we're going to take an in-depth look at both options as we walk through an example of what would happen if someone needs care and goes on claim. Now, the goal of the webinar is not to convince you that reimbursement is always better than indemnity, or that indemnity is always better than reimbursement. Rather, our goal here is to provide information to you as the agent so that you can then have a conversation with your client about the differences between the two methods and then help them make an informed decision on which method would be best for them, which will help you make the right product recommendation from there.
And also, Blake, everybody on the right-hand side of your screen where those handouts are, there is a Q&A box. That's where you'll ask your questions, and we'll be standing by to answer those. Thank you.
All right, so as we go through this presentation, we're going to talk about John and Mary, who are basically a hypothetical couple that we're going to use as we explore the claim from the view of both indemnity and reimbursement. So we're going to assume that they purchased a hybrid long-term care policy 15 years ago. The policy has a $6,000 maximum monthly benefit amount to it. It also has a $300,000 death benefit. And they also originally purchased the continuation of benefits rider on that contract. Now, for those of you who are new to LTC policies, this is the option that allows the LTC benefits to continue after the death benefit has been exhausted. So even though there's no death benefit left at that point, once it's been used up for LTC, the LTC benefits will keep going due to that continuation rider. Now, John has begun needing some support with normal activities of daily living, and John and Mary have decided that it's time to start using their policy. So let's go ahead and see what happens next here. So as we walk through the different stages of the claim and the care needs for John, what I'm going to do is really take just a side-by-side look at what would happen if it was both an indemnity and a reimbursement contract. Now, in the interest of full disclosure, One America only has reimbursement contracts at the current time, but we do know that this topic comes up frequently in long-term care discussions, and we want to make sure that you understand the ins and outs of both. This will make you better equipped to talk about the options available in the marketplace with your clients. So when the claim starts, it's going to begin identically for both indemnity and reimbursement methods. John or Mary will reach out to the insurance company to begin the claims process. Now at this point, John's meeting the requirements to start a claim, as his doctor has determined that he is considered chronically ill, which means that he is needing substantial care and is failing 2 of 6 activities of daily living, also called ADLs for short. Now, if you're unfamiliar with activities of daily living, those are 6 activities that every person does every day on their own. Those activities are bathing, transferring, toileting, eating, continence, and dressing. John's doctor is also certified that he thinks that care will be needed for more than 90 days, which is an additional requirement to go on claim with both types of contracts. So you're deemed chronically ill when you either have a cognitive impairment or you cannot perform 2 or more ADLs without substantial help, and that is anticipated to last for at least 90 days. So they'll have to submit paperwork and proof to the insurance company for a claim to begin payment for John. So John and his family are wanting to begin care at home with the goal of staying in the home for as long as possible. Now, one important note is that under both types of contracts, the insurance company may require recertification at least every 12 months to determine if John still qualifies as chronically ill and to keep receiving the benefits. So John begins his care at home. We'll have someone come in to assist with bathing, transferring, and other care he might need. And at this point, his care expenses are running $3,000 a month to start. With an indemnity plan, it will pay the full monthly benefit regardless of actual expenses, provided that John is qualifying for the benefits, and we know that he has. So for example, we know John has a $6,000 monthly benefit and he only has $3,000 a month in claims expenses. But the insurance company would still pay John the full $6,000. Now, these funds will be paid directly to the policy owner, and the policy owner will then need to disperse them as needed to the caregivers. Now, reimbursement, on the other hand, is going to pay the exact amount of expenses up to the maximum monthly benefit allowed, again, provided that he's qualifying for claim. So using our previous example of $6,000 in monthly benefit and having $3,000 in LTC expenses, a reimbursement policy would only pay John $3,000 to cover his expenses. The remaining $3,000 of unused monthly benefit is going to stay in the policy and make it last longer. Now, these reimbursement payments can be paid either directly to the caregiving agency or the policy owner to reimburse for expenses. So this is one place where reimbursement policies can differ from indemnity contracts as far as where the money goes once it's paid from the insurance company out to either the client or to a caregiver agency. So to continue our discussion around bill paying, we'll take a closer look at how this works under both types of plans. So under the indemnity style, bills are handled by the insured or their loved ones. So they're going to be responsible for paying the caregivers and any other bills that the funds are being used for, and they'll be responsible for doing that on their own. Also, all receipts will need to be kept for 7 years in case of an IRS audit, which could inquire into how the funds are spent. So this is going to require a lot of record keeping to ensure that funds are accounted for and to determine if any additional taxation is required. Now, it's important to realize that this can create a lot of extra work and burden on the family, especially during an already difficult time. With reimbursement contracts, the policy owner can opt to utilize direct billing, where the insurance company is going to pay the caregiving agency directly without the need for the client or their family to be the middleman. So basically, the agency sends us the bill or sends the insurance company the bill. The insurance company turns around and sends a check back to the caregiving agency. Alternatively, the client could choose to pay the caregiving agency themselves and get reimbursed by the insurance company. At One America, we typically see clients opt for the direct billing method because of the benefit of alleviating the extra burden or work on family and loved ones. One additional thing to note here is that at One America, clients and their families can also leverage services at this point in the claim for things like care coordination and Care Scout to establish a plan of care, review risks, inventory financial resources, provide education, and more. Moving along here, a common question that comes up when comparing indemnity and reimbursement contracts is, who can provide care for John? So a frequent thought that we hear when someone is considering an indemnity policy over reimbursement is the idea to use the monthly benefit to pay children, neighbors, or friends to care for them. So basically an informal caregiver. This is true. With an indemnity plan, anybody can provide care for John, and it does not have to be a licensed caregiver. They can also opt to use funds for other expenses not tied to caregiving. So there is some flexibility there on who to pay and how to spend the money. Now, one important thing to note is if the policy owner decides to pay a family member, neighbor, or friend to care for John, so in other words, an informal caregiver, the individual being paid by law needs to receive a W-2 and claim that money as earned income, as they are now considered a household employee if they receive more than $2,600 in a year for their services. So the client and or their family members are now essentially in the role of an employer responsible for all the financial record keeping of issuing W-2s, potentially withholding taxes, paying the employer portion of the federal tax, and more. So by not explaining that thoroughly, the caregiver could potentially fall into a higher tax bracket and not be prepared for the higher tax bills. The client and their family can also be caught off guard with a lot of extra work there. So that right there is something you definitely want to be discussing, because that's typically not addressed by most people when having the discussion around indemnity policies. So under a reimbursement plan, a trained professional is normally required to provide the proper care for John and be held accountable to do so. Also, when John's nurse or CNA needs to take a day off, the caregiving company or agency will have another professional fill in to ensure that his care continues to be met. This will most likely be easier and more seamless versus coordinating days off for an informal caregiver, such as a family member or friend, providing under an indemnity policy. Now, one important thing to note, because I know that this webinar is for California agents, if you are selling in California, even though One America is a reimbursement contract, we do technically have a provision for California policies, and it is California policies only. Outside of California, this is not true. But in California, there is a provision that would allow for an informal caregiver, even though we are a reimbursement policy. So we can provide some documentation that the family or the client would fill out, along with providing some copies of canceled checks, and you can be reimbursed for an informal caregiver. Now, one thing to note with our policy is that if you are using an informal caregiver with asset care in California, it cannot be a family member. So that's one important thing to note. So it would have to be someone outside of the family. But really from there, anybody would be able to provide care. You wouldn't necessarily have to hire a nurse or a CNA or anything. You could hire someone like your neighbor. So that is, again, one thing I wanted to call out there, since I know a lot of you are selling there in California. Now, keep in mind, though, when we talk about informal caregiving and things like that, especially having families take care of the client, that long-term care plans are really designed for family members to be the care supervisor instead of the caregiver. And there really is a big difference between the two. We find that most people who have put a plan in place for long-term care do not want their children providing the care. They want them to have the funds available for a caregiver, and then the adult children can oversee the care. So this allows those adult children to continue to live their own lives, which includes things like their careers, marriage, being there for their own kids' lives. So for example, a care supervisor, so in this case, we'll say it's John's daughter, is at her child's t-ball game, catching the game and being involved in her child's life. If she were a caregiver, she could potentially be stuck at home with John, missing that game. So another question that comes up is around home modifications or supportive equipment, and what benefits can be received from that plan. Now let's say that John is looking to modify a shower or reduce the risk of falling, or maybe add a wheelchair ramp to the home. With indemnity contracts, John will receive the full monthly benefit, and he can utilize it to pay for home modifications or supportive equipment. Remember that John's managing the funds himself on the indemnity plan, so he basically can do whatever he would like with those dollars. Reimbursement policies, like One America's, do typically allow for supportive equipment and home modifications, and the One America product does do that. With our policies, the supportive equipment benefit is in addition to the monthly benefit that John would be receiving for care expenses. Another benefit is our relationship with CareScout that offers help assessing the home for risks and making recommendations. So at the end of the day, both plan types would allow someone like John to be able to stay in the home and modify it as needed. Now at this point, John's been on claim for 3 years, and he is needing a higher level of care. So he and his family have decided to transition him over to an assisted living facility, with his care costs jumping up to $6,000 a month. You will notice that this slide here looks similar to one earlier, as the contracts are really still working the same way as they were before for John. Both the indemnity contract and the reimbursement contract are paying out the max monthly benefit to him, as his care costs are now equal to the max monthly benefit. The only major difference at this point is how the bills are being managed, either completely by John and his family under an indemnity contract, or by potentially using the direct billing method from the facility to the insurance company under the reimbursement method. So what happens if John's claims last longer than 7 years? So this is a time when potentially we could see a benefit with the reimbursement contracts. So an indemnity policy is designed to pay out the max monthly benefit regardless of the cost for care. They're also designed with a limited duration and limited LTC pool due to the nature of how the policy works. In some cases, these funds, the funds that were not used for care, could have been set aside for future needs. So we're talking about earlier in the claim. However, we often hear people encourage policy owners to accept the entire amount of an indemnity payout to pay for other things, such as lawn care, a grandchild's college tuition, paying off the mortgage, gifting, or other things. John may have spent the entire benefit amount in the early days when care was less expensive, and he's now out of benefits when his cost is much higher. With a reimbursement policy, while John was receiving care benefits at home, remember that he was not using his entire monthly benefit, which has now extended the length of time that his policy would last. Even if it was a policy with a limited duration or limited LTC pool, he could still have benefits available to pay for his continued care since they weren't paid out in the early years of claim. Also, with reimbursement policies, they're the only structure available for lifetime benefits. Remember that lifetime benefits mirror what insurance was designed to do, which is take the catastrophic risk off of the individual. And at the end of the day, that's what you really want to make sure that you do for the clients with any type of insurance, whether that's LTC insurance or homeowners insurance or anything else that you may be working with them on. The IRS per diem limit is also a commonly missed topic and one that can have a huge impact on clients. Where this most commonly comes into play is contracts with inflation protection, where monthly benefits have grown to a much larger dollar amount over time. So under the indemnity method, the IRS sets a per diem limit on how much long-term care benefit may be received before a tax is imposed on any benefits above the daily limit and the incurred expenses. In 2023, the per diem limit is $420 per day. Anything over that per diem rate could be fully taxable to the owner if it was not used for care. For example, if John had an indemnity contract that had grown to a $15,000 monthly benefit and he took the entire monthly benefit, if he incurred less than $15,000 in expenses, he could potentially owe taxes on up to $2,400 worth of those benefits in 2023, since that amount would be above the IRS per diem limits. If you extrapolate that out over the course of the year, he could add up to nearly $30,000 to his taxable income. Would that push him into a higher tax bracket for the year as well? Yeah, potentially it could. So that's something to watch out for. So the per diem limits can seem high at first, but they can easily be surpassed when considering inflation on a policy. Now, because reimbursement policies can only pay for the actual incurred expenses, there is no per diem limit by the IRS. So taxation is not a concern with reimbursement policies, as all benefits will be paid out tax-free, even if they have a high monthly benefit. So if John has a high reimbursement contract, the IRS per diem rate does not apply. And so he and his family can know and be assured that they won't be creating a taxable event by receiving LTC benefits from this policy. So the final area covered today when discussing reimbursement and indemnity is all those unseen things that don't show up in contract language, but have big impacts on people. So the actual cost of care isn't only monetary. And when family is involved with providing care, it can create unforeseen dynamics. We all know that caring for an aging parent can have a huge impact on the family. As we briefly mentioned earlier, with an indemnity contract, a lot of questions can come up, like who's going to provide care, who's available to assist, should the family carry the burden of care versus hiring a professional to conserve the cash in the policy, and more. Situations like that can create added stressors to the family, as there may be disagreements over care and how to manage the bills. Another issue with having a loved one care for you is that he or she may not be properly trained. So therefore, the parent may inadvertently not receive the proper care. So by promoting the idea of a family member caring for John when they may not be physically able or mentally prepared to be that caregiver, it could make an already tough time worse. So long story short, this could lead to unintentional elder abuse. The last factor we'll address with indemnity is costs. I always like to point out that with indemnity policies, you're paying higher premiums for benefits that the insured doesn't need for care. Now, the advantage with indemnity is getting a full monthly benefit when you don't need it, but the insurance carrier charges a higher premium for it, knowing that you'll always be getting the full monthly benefit. So in theory, you're paying more premium for care benefits that you don't necessarily need. At the end of the day, it's extremely important to let loved ones be care supervisors instead of caregivers, so that the adult children can carry on with their normal lives, all while overseeing mom and dad's care. They can work closely with the care benefit concierge and care coordinator, such as Care Scout, to help make that process seamless and less stressful on everyone. Also, if they included the lifetime benefit rider, they can have peace of mind knowing that the funds will continue for as long as care is needed. So on the surface, indemnity may seem more flexible. However, it can actually create a lot of additional burdens work on the family, from maintaining receipts, finding caregivers, taxes and tax documentation, running out of benefits early, and more. With reimbursement policies, a lot of times they have the reputation for being less flexible. However, when you take a closer look at it, it can cover the largest needs and concerns that clients have. Burdens can be lessened, claims processes can be streamlined, allowing the family to focus on enjoying the time with their loved one as a care supervisor. So does that mean that one is always better than the other? No, it doesn't. But we do want to make you aware of the facts so that you can educate your clients about the differences and make the right choice when it comes to putting a plan in place to protect themselves from an extended care event. After all, when choosing a long-term care insurance company, clients want to know that they are making an informed decision and choosing a company with plenty of experience. Here at One America, we have over 30 years of experience not only offering these policies, but more importantly, actually paying claims. So many carriers have jumped into the market with policies and quickly left due to their claims experience and pricing. Our policies are really priced for the long haul because we have the experience and we know that they're priced appropriately. Understanding the desires of families and the insured is really our specialty and has been for years. After receiving feedback from numerous clients through the years, one thing that they've been very clear about is they do not want their children to put their lives on hold to take care of them. So our policies afford them the benefit of paying others to do things that they don't want their children to be doing. Making sure that there's a professionally trained caregiver providing the help that they need will also keep the accountability high for the insured's care and minimize the potential for neglect and/or abuse of the insured. Their family and friends are overseeing the care rather than providing care themselves. Also, by making sure that they have an unlimited pool of dollars with their lifetime benefit rider to pay for one or both insured's care, we're helping them with what they're most afraid of, which is a very long need for dollars to cover care. Alzheimer's, Parkinson's, and dementia diagnoses have really increased substantially due to longer life expectancies. You'll start seeing longer and larger LTC claims due to that fact. Now, you may be asking yourself at this point, who is One America and what do your products look like? So let's just take a couple of minutes to answer that question. So you can see a picture of our headquarters on the screen, which is located here in downtown Indianapolis, Indiana. We trace our roots back to 1877 and have some of the strongest ratings in the industry. We were one of the first companies to offer an asset-based LTC product by launching Asset Care 35 years ago. And our unique product features include joint coverage, lifetime benefits, and a variety of different funding options. We're also a mutual company, which means that our policy holders own the company. This allows us to look long-term and be there for our clients when they need them most. So just very briefly, here's a high-level view of what our products look like. You may be familiar with this if you've already sold our products, but if you're not, it's just a great intro before doing further deep dives into our product line. So what would happen with our product line is you are purchasing a whole life insurance contract. If you ever need it for care, you're going to spend down that death benefit first, dollar for dollar. And if you use that up, then you can move into the continuation of benefits rider, which is a pool of additional dollars for care that we as an insurance company are providing. And that's where the actual lifetime coverage that I've mentioned a few times in this presentation comes in. So again, lifetime benefits say that no matter how long you're on claim, you're going to be covered. There's a variety of different funding options for both the base policy as well as that COB rider. You can see that we can fund the policy with a single premium. We can pay it over time with things such as a 10 pay, a 20 pay, or a continuous pay. We do accept qualified money as well. That's a big deal with us. And we can also accept 1035 exchanges as well. One thing to note with the continuation of benefits rider is that there are some tax advantages there, because you can either use HSA dollars to pay for it, or you could potentially write the cost of the COB rider off as a medical expense through the client's taxes. So the two things that the clients, the affluent and mass affluent clients are really looking for, which is leverage on their dollars and tax advantages, our product is providing those for them. So where do you go from here? Well, there's a couple things you can do moving forward to familiarize yourself with our products and work to present them to your clients. One thing you could do is to check out our Care Solutions Calculator. So the website there is on your screen. If you go to that website, you can actually run an illustration just like you would get if you were to call me and ask for one, or if you reach out to Crump and ask for one. So you can familiarize yourself with the policy design, how they work, what the illustrations look like, things like that. Now, one thing to note is that is just an open general site, and at the very top of that site, it mentions submitting an application. It says, click here to submit an app. Please do not click on that button there. We ask that since you're with World Financial Group and Transamerica, that you run all your business through Crump's Transaction Center that Susan was discussing earlier. So if you reach the point where you're taking an application, please go to the Crump Transaction Center and not through that site. A couple other things that you can do is look for some in-person training options. There is a QR code on your screen right now. I'd encourage you to pull out your phone, scan that QR code. What it will do is it's going to bring up a website with various regional meetings that are happening all across the country right now. Those regional meetings are lunch and learns. They typically last about an hour and a half. They normally take place at a local restaurant, and basically you get a free lunch while you can meet your wholesaler, your One America wholesaler, and also learn more about the products. Now, if you click on that QR code right now, if nothing is available in your local area at the current time, check back from time to time. That website is updated on a regular basis. And so as we plan more and more events, we add those to that site, and then you can click and register at that time. And then finally, one other way you can reach us here, this is a map of our One America regionally based wholesaling teams. So all of these wholesalers are willing and available to come work directly with you as agents. The different colors on the screen are the different regions that they cover. The QR code in the middle of your screen, please go ahead and scan that, or you can click on the handout section and there's a PDF of the same thing there. That QR code will bring up not only the color-coded map, but also the names and their contact information, so phone number and email, for all of the various wholesaling teams across the country. So then you can look and see where you're located at and go from there and reach out to the appropriate wholesaler. One thing to note when looking at that map is that it is based upon your home address. So it's based upon where you actually live. It's not based upon your office address. It's your home address. So you may live in one spot and your office may be elsewhere. Look based on where your home is at. So at this point, that is what I have here for you today. Susan, it looks like you're still on the line here with us. I know you'd like to do Q&A at the very end for just a couple moments. So I will go ahead and turn it back over to you, and we can touch on any questions that came up in the chat there. So Susan?
Okay, great. Thanks, Blake. So we did have some questions. I've been doing my best to answer them on the side. If your question wasn't answered exactly what you asked, you know how questions are. So feel free to email us or contact your wholesaler, and certainly we can get more details to you, of course. There's a question about, doesn't a family member or someone not employed by an agency receive a 1099 versus W-2?
Mm-hmm. Yeah, so it's good question. That's been coming up a lot recently, as far as whether that informal caregiver should be, receiving W-2 versus 1099. So there's more information on one of the handouts that you can pull. The handout is titled Reimbursement and Indemnity. And on that form, there is both a QR code and a link to what's called Publication 926 of the IRS. That essentially dives into how you define a household employee. When you look at how they are defining it around what work is being done and who's defining when and where it's done and things like that, caregiving actually falls under a household employee. So therefore, because they're a true employee as opposed to a contractor, they would then need a W-2 as opposed to a 1099. Again, if you want to dive into all the IRS language, you can check out that publication. But in short, that's why we keep saying W-2 versus 1099.
Yeah, it can get tricky with that. So definitely download that reimbursement and indemnity basics document, so you'll have that IRS code. And mainly, you'll be referring clients to their accountant. But you want to be aware of these differences, so you're not just announcing, oh, this is long-term care, so it's tax-free benefits, and you're announcing, oh, there's no problem, the carrier and provider can bill and pay each other, because those things are, dependent upon the carrier and how they pay. So you want to make sure you're giving the right information to your client. They're trusting you, as I say, people know, like, and trust you. That's why they're doing business with you. So we want to give proper and good information to people. Can a policy owner use indemnity LTC money to buy food or other things like travel? What happens if the LTC indemnity benefit money is not totally spent on care?
Sure. So technically, they can spend the money however they like, right? There's not, according to the company is just going to send them that check. However, you are going to have to keep track of records to be able to say, here's how much was spent on care, here's what wasn't used for care. Now, there is some leeway there, but that then gets into the per diem limits that we were talking about. So, if you have an indemnity policy and, it's paying out, say, $15,000 a month, but your let's say your care expenses are only $10,000, right? There's a $5,000 difference there. Above a certain amount, which is $420 per day, which is going to work out to be a little over $12,000 a month. Anything over that amount is then potentially subject to full taxation. So so that's the scenario then where you're getting into having to add that to your income and things like that. So you've kind of got to be there and be careful around, okay, how much is this policy going to pay? What will the per diem limits be at that point? Is all of this money being used for care, or is it being used for other things like that? So long story short, yes, it can be used for other things, but at the same time, depending upon how much it is, it could also become a taxable event to you, depending upon the scenario.
So someone asks, on a reimbursement contract, is there no need to keep receipts for 7 years? Now, I'm assuming I answered the question based on just reimbursement in general. You don't have to keep receipts. You're either submitting your bills or you're submitting your receipts and you're being reimbursed, or you're doing assignment of benefits where the carrier and the provider are talking to one another and they're paying each other and you don't have a bill or a receipt. I'm assuming that 7-year language question is part of IRS and keeping records for the IRS, but I would imagine you would only really want to do that with a cash policy. You don't need to do that with reimbursement. Is that right? What's your answer on that one?
Yeah, so yeah, I think you're on the right track there. With reimbursement, the insurance company is receiving those receipts, verifying them, and sending out the money. Now, at the end of the year, with the reimbursement policy, you will receive I believe it's a 1099 LTC. I think that's what it's called. I'd have to double check the language there. Essentially, it says that you receive these benefits, but it's going to be marked on that form as a non-taxable event because it was reimbursement. So essentially, it's just for your own documentation there in case it ever gets questioned. So you'd probably have to hold on to that one form, but that would be it. It would be hold on to this one tax form. I don't need to keep a big binder worth of 50 pages each month worth of expenses.
Right. But if you have a cash indemnity policy, you're keeping your receipts for the purpose of proving to the government that you spent that money on healthcare. Because if you didn't spend it on healthcare and you received more than $12,600 a month or $420 a day, you've got to either prove you spent it on healthcare or pay taxes on that money. And so, and they're not going to want, the government is not going to want receipts just on the overage. The taxes on the overage, but they're going to want you to prove where you spent all the money. So you can't say, well, I spent the first $12,000 buying food and paying my bills and all that, and then over that, yeah, I spent that on healthcare. No, you've got to have receipts for the whole amount. So this is really important, and sometimes people just won't even care. At the end of the day, they bought cash because they really want to be able to have the flexibility of hiring anybody under the sun, their neighbor, niece, housekeeper, daughter, whatever, the nice little person down the street. And that's fine because that's what you're able to do with that. But you just know you might have to pay some taxes. So I wouldn't care if I had to pay a little bit of taxes if I wanted that flexibility, but you have to talk to your clients about what they think they want and what may happen at the end of the day, because you know what, you might not be around. You may be retired as the agent. And so who are they going to call and say, hey, I didn't understand all this. I bought this. This agent said it was great. They love cash. I should buy cash. Now I bought it. I got a tax problem. I have this problem or that problem. I can't do assignment of benefits. I have nobody to manage the cash in my life that's responsible. What's happening? So make sure you're explaining all this when you're selling something, and let your client decide cash or reimbursement. I've had people tell me, absolutely, I'm never buying cash. And I've had people in client conference calls tell me, I'm only going to buy cash. So it really is a personal decision. And as most of you know that have heard me on a webinar, I own one of each. So I don't think one's better than the other. And I'm not trying to sway you either way. I'm trying to sway you to have a conversation with your client about the whole pros and cons about this. So that's what today's purpose was. We don't have any more questions, so I'm going to say thank you so much for joining us today. Have a great rest of your day, and don't forget to join us next month and also on the Crump Long-Term Care webinars as well. Blake, thanks so much for your knowledge and expertise today.
Thank you all. Appreciate you all joining us. Have a great day.